Welcome to the Transparent FX Academy. I'm Nick and I'm a top author on TradingView with over 190k reputation points. In this tutorial, I will be speaking about accumulation and distribution areas, which are the most important turning points when it comes to market structure. So a follow through from the previous tutorial. Now, I got a lot of questions about accumulation and distribution areas, and that makes a lot of sense because there are quite important levels in the market. It is important to have a deep understanding of exactly what they are and how to use them to your advantage. So first I will be explaining what accumulation and distribution areas are. Then we will be looking at how you can integrate a commitment of traders analysis. So what the big players, so hedge funds and institutions in the market are doing with accumulation and distribution areas to see if actually institutions are moving a large amount of orders inside of those areas. And then we will be putting together these two concepts to see how you could potentially use them to your advantage. So without further ado, let's get right into it. Okay, so first of all, what is an accumulation or distribution area? Now, these are important turning zones in the market. So if the market is in a downtrend, so creating lower lows and lower highs, if at the bottom of a downtrend, the market then starts moving horizontally like this is what is commonly referred to as an accumulation zone, because it means that usually institutions are adding longs inside of this zone, and then after that there is an inversion of the trend. On the other hand, a distribution area is simply the inverse of an accumulation area. So if the market is in uptrend and then the market starts to exhibit a ranging behavior, that is what is commonly referred to as a distribution area. And usually in this area, institutions are loading up their shorts, and then the market essentially reverses its trend. Now, what you might be asking yourself is, okay, but why does the market behave like this? Why do institutions essentially need a ranging market in order to change their positioning? And the answer to that is quite simply how the main difference is how institutions have to trade with respect to how retail traders have to trade. Now, when it comes to retail traders, we can just push the button and the order gets immediately filled, right? However, for institutions, since they have such massive orders, they need a lot of time, so to speak, to actually place their full order. Because remember that in the market, for every buyer, there needs to be a seller. For every seller, there needs to be a buyer. So if at that specific moment, there aren't enough buyers or sellers, depending if they want to long or short. So let's say, for example, they want to long, and at that specific moment, there aren't enough sellers that are willing to sell their currency to them. For example, if it is Euro USD, there aren't enough sellers of the Euro for them to buy with their USD. They have to split their orders in time. And that is why a ranging zone is perfect, because it keeps the price steady while they're able to accumulate all their longs. And only at that point, after the accumulation is finished, the market starts the rejection to the upside. Same thing for a distribution area. So that is why the market, and most importantly, institutions in the market, need these areas, and why after zones like this, the market tends to react to these accumulations or distributions and invert the trend. Let's go and see how this actually works out in practice, because we just had a clear live market example of this for USD CHF. In fact, what we can notice is that first, the market was in a downtrend, right? So exactly as we have seen here, the market was creating lower lows and lower highs. Then the market started creating this horizontal accumulation zone. And then the market shifted now to creating higher highs and higher lows. So exactly what we have shown here. First, downtrend, clearly with lower lows and lower highs. Then horizontal accumulation period here. And now higher highs and higher lows. So let's go and see if in fact, during this move here, institutions during this accumulation phase were actually adding longs, preparing for this inversion of the trend. In order to do that, we have to go and see what we have when it comes to the commitment of traders, which is what hedge funds and the big players, so essentially the non-commercials in the market, big institutions that are in the market just for profit, what are they doing in the market? And if we look at the data for the CHF, we can see how with the last reports, in fact, institutions have been decreasing their net positions, going from minus 17.1k net positions all the way down to minus 26.1k net positions, with an extra 2,900 shorts just added with the last report and 785 longs getting closed. So clearly institutions with the last reports in the last weeks, they have been moving to the bearish side of the CHF. And keep in mind that all currencies on the spot are traded against the USD. So if institutions are shorting the CHF, what they are actually doing is longing USD CHF, because if you short the CHF and the CHF is traded against the USD, you're actually longing USD CHF. So during this horizontal accumulation, institutions were in fact longing USD CHF, as we can see from the commitment of traders. And after that, the trend in fact inverted. So that is how you can use accumulation and distribution areas combined with the commitment of traders to your advantage potentially, because you can, first of all, learn to spot these patterns, because once you know how to spot an accumulation or distribution area at the bottom or at the top of an uptrend or downtrend, at that point, you could go and check the commitment of traders and see, okay, so are institutions inside of this ranging phase moving to the opposite side of the trend that was present? So if, for example, you have a downtrend like the one that you had right here, okay, you have a market which is moving in this downtrend, and then the market starts moving horizontally, you can go and check the commitment of traders and say, okay, so are institutions actually, let's say you have a situation like this, and you say, okay, so are institutions actually moving to the opposite side? Let's say you were here, you had this price action developing, you went to the commitment of traders and said, okay, so actually institutions are now decreasing their net positions. So they are moving to the bearish side for the CHF. So this is supposed to make USD CHF stronger because they are expecting a push to the upside because they're longing USD CHF with massive orders. And at that point, you have already a directional bias on this market because you say, okay, at this point, there is an increased probability to see a potential rejection to the upside, which is then in fact exactly what the market followed through with doing, completely inverting the trend from downtrend to uptrend. So at this point, you could also potentially build a strategy around this and say, okay, so if you have this kind of price action from a weekly perspective, then at that point, what I might do is go down, I don't know, for example, on an intraday time frame, like the 4-hour time frame. And at that point, I'm looking for an inversion of the trend on the 4-hour time frame to then potentially be looking for some longs when the market shifts structure. Like, for example, it shifted structure here when I created the first new 4-hour higher high. I'm looking for a 1 to 3 risk to reward. So there are a lot of things that you can build. On top of that, you could potentially build a strategy around these kind of concepts. The very important thing to always keep in mind is that when it comes to developing any kind of strategy, you always have to follow proper steps. So first, backtesting and defining the rules of the strategy, potentially also automating the strategy with MQL4 or MQL5. You can develop an EA based on the rules of that strategy, so then you can backtest it easily on high quality historical data. Then you can be looking to demo trading the strategy to see that also in live conditions, it is performing as it was performing in the back testing. And these are all kind of things that I do teach also in the mentorship program. So I hope you enjoyed this tutorial and it gave you some insights on what accumulation and distributions areas are and how you could potentially use them to your advantage. Now, if you want to learn more, I really suggest that you go and check out the transparentfxtrading.com website, which you find linked in description. Here, you have the possibility to gain access to the most complete mentorship program ever that I have created. You have the possibility to gain access to all the courses, the trading station software with the Telegram signals integration, one-on-one private mentoring directly with me, the COT data software that you see me use in all these videos. And if you continue to scroll down the website, past the testimonials, you will see that you have the possibility to join and gain automatically access with the email and password that you will create during the sign-up process. So I really suggest that you go and check it out. The link is in the description and I will see you in it. If you enjoyed the video, make sure to drop a like. Also, if you have any suggestions on any topics or pairs that you would like me to cover in the next videos, make sure to drop them in the comments below and I will see you in my next video.